Fretted about gloomy prospects, traders eventually discovered a long-awaited piece in the puzzle of the economic future in the United States. Red-hot inflation data did not come as a bombshell. Good news is that the CPI did not spook investors. Inflationary pressure is ebbing away, so Wall Street perked up and regained optimism. The US stock market traded quietly in anticipation of the inflation report. The trading volume was much lower than average. The benchmark stock indexes closed in the red. The major stock indexes went deeper in the negative territory. The Dow Jones lost 56 points or 0.17%. The Nasdaq shed 0.63%. The S&P 500 slipped by 0.46% to close at 4,119 points. The New York pre-market also displayed sell-offs. However, market sentiment on Wall Street changed crucially following the CPI report. The benchmark indexes reversed by 0.4 and 0.9%. The S&P 500 is expected to trade in the intraday corridor between 4,010 and 4,240 points. The reason behind cautious trading on Wall Street yesterday was the meeting of the US policymakers and their discussions on the federal debt ceiling. The US government could default on its debt on June 1 unless Congress takes action. President Joe Biden and lawmakers agreed on Tuesday to arrange further talks aimed at finding the solution. The president reiterated that the Republicans should eliminate the default threat. Economists warn that the protracted default could push the U.S. economy into a deep recession, accompanied by a sharp increase in unemployment rates and derail the whole global financial system. Previously, the debates on the debt ceiling commonly ended by a last-minute agreement which prevented a default in 2011. The jitters among policymakers led to the historic decrease on the sovereign credit rating. The current gridlock poses a more serious risks. As for the corporate news, market sentiment was dampened by dismal forecasts from PayPal and Skyworks, Apple's supplier. Their shares sank by 12.73% and 5.25% respectively. PayPal shares affected the S&P 500 after the company downgraded its emerging forecasts. Skyworks shares fell after the company presented a revenue and a profit forecast for the second quarter below the consensus. The stock of other Apple suppliers, such as Qualcomm, Broadcom, and Huawei, also went down. Boeing shares grew by 2.34% after low-cost carrier Ryanair placed an order to buy an aircraft worth billions of dollars. Novaworks shares surged by 27.79% as the drug manufacturer planned to cut 25% of jobs worldwide. PacWest shares had another volatile session because shares of regional banks incurred huge losses. In the end, bank shares closed 2.35% up. Federal prosecutors in Washington are looking into short seller activity and urged the SEC to probe significant short sales of bank shares. Oddly, short selling followed upbeat profit and loss reports. The activity around the banking crisis is an area of interest for the Justice Department. Analytical think tank Outdex estimated that short sellers gained profits in the amount of $1.2 billion in the first 2 days of May. Today, market participants are shifting focus from the Angry fought between the Republicans and Democrats and bank woes towards the economic calendar, investors were riveted to inflation data to check whether the Federal Reserve managed to bring down high inflation. The market can judge on a Fed's readiness to hit a pause button on rate hikes by a few crucial metrics. The inflation data for April is number one on the list. Most metrics in the inflation report from the US Labor Department matched expectations. The annual rate, excluding volatile food and energy prices, inched down to 5.5% in April from a 5.6% in March, in line with the expectations. Besides, the CPI climbed by 0.4% in April on rents from a 0.1% uptick in March. Prices of real estate, second-hand cars and gasoline were the main driving forces in inflation. The annual CPI came as a pleasant surprise. The figure dropped to 4.9% in April, lower than the expected decline to 5%. It's the lowest level since April 2021. Food prices grew at a slower pace and energy prices went down. Moreover, real estate prices that account for more than 30% of the total CPI's value declined for the first time in 2 years. Despite the fact that the figures are way below the Fed's target of 2%, there is enough evidence to suppose that the Fed's campaign is over and deflation is still going on. Curiously, the Fed officials are unwilling to acknowledge this in public. The Fed funds futures suggest only 15% chance of another rate hike next month. At the same time, a rate cut by 25 basis points has been already priced in. Anyway, Wall Street is taking a breath today and enjoying optimism. The corporate sector has already perked up. Stocks of high-tech giants such as Apple, Microsoft, Tesla and Meta have won back early losses and rose by 0.6% and 2.2% in the pre-market. The banking sector and the energy shares are also gaining ground. Occidental petroleum shares are the only bad performer today. The shares fell by 1.5% because its profits in the first quarter were worse than the consensus. The US dollar index reversed abruptly downward in the midday. Its index went down by 0.27% immediately after the CPI report traded 101.30. The intraday corridor for the index is seen between 100.8 and 101.50. The US dollar traded on a seesaw on Wednesday because Joe Biden and lawmakers did not achieve any progress to settle the debt ceiling issue. The greenback also fell prey to easing inflationary pressure, and yesterday the US dollar stood tall. On the one hand, Fed funds futures negated the outlook of another rate hike by the US Fed. On the other hand, the greenback found support from Fed speakers. New York Fed President John Williams said that inflation remains too high, that the central bank could raise interest rates again if necessary, even though the Fed gave up their recommendation for further rate hikes. The weakness in the US dollar reinforced the Canadian rival. The USD card pair dipped by 0.2% following the US CPI to trade at 1.3357. The instrument is likely to trade in the intraday corridor between 1.3320 and 1.3390. The fresh data on the Canadian construction sector caught traders off guard. The overall worth of building permits in Canada expanded by 11.3% to $11.8 billion in March, following a modest growth of 5.5%. The actual reading defied the expected decline by 2.9%, and the non-residential sector surged by 32% to the record level of $5.2 billion. On the flip side, the loonie is wound down by falling oil prices. Crude oil snapped a three-day rally because unexpected growth in the US oil inventories aroused concern about demand. US crude stockpiles rose by 3.6 million barrels last week, while gasoline inventories expanded by 399,000 barrels. The sudden growth in the US stock alongside a decrease in oil imports and weak demand in China cemented fears about the global energy demand. In response, Brent crude declined by 0.7% to trade at $76.83 a barrel, and WTI lost 1% to trade at $72.97 per barrel. As for the crypto market, popular tokens are trading almost flat. Bitcoin is trading at about 27,650 for the most today. The crypto market welcomed the US inflation data. Bitcoin instantly gained more than 1% and approached $28,000. Top altcoins quickly followed suit. Ethereum, Solana, Ripple, and Cardano grew by 0.6 and 1.3%. Binance and Litecoin shed 0.2 and 0.3%. As for the industry news, the UK Finance Minister stated that the country is about to make the decision on the issue of the digital pound sterling. In February, the Exchequer and the Bank of England began consultations on the digital version of the sterling. Though the final decision has not been reached yet, the Chancellor said yesterday that the UK had to accept changes in payments. The kingdom should not lag behind global innovations where non-cash payments already stand at 86%. Despite the fresh impetus gained from the United States inflation data, Bitcoin's rally could be limited. The token might get trapped in the range of 27,650 to 28,200. If the price breaks the upper border, the door will be open to $28,600 and $29,200. Traders should neglect the scenario of a decline to 27,200. And that's all for now. We continue monitoring the financial and commodities market situation. Subscribe to our channel and leave your comments down below. See you tomorrow.